Excellencies, distinguished delegates, ladies and gentlemen, I am Claire Bernard, your moderator for this side event, focusing on financing for development, with special emphasis on catastrophe bonds. On behalf of Senator the Honorable Kamina Johnson-Smith, Minister of Foreign Affairs and Foreign Trade, and the entire Jamaican delegation, I extend a very warm welcome to you all for joining this our side event. This year, Jamaica conducted its second voluntary national review for presentation to the high-level political forum. This report highlights the importance of sustainable financing to achieving the priorities of the 2030 agenda. Given Jamaica's exposure to multiple hazards and the inherent vulnerabilities we face as a small island developing state, addressing disaster risk financing looms very large in our report. Jamaica's development efforts, like those of many states, have been adversely affected by the impact of natural disasters. In the past 2 decades alone, the economic impact of damage and losses have averaged 1 to 2% of GDP annually. We recognize that minimizing disaster impacts and building resilience requires collaboration and partnership at the international, national, and local levels. This multi-level approach, we believe, enables the transfer of knowledge and technology, increased financing options, political commitment, and integration of risk management in development planning. Today's event is part of Jamaica's contribution to the conversation of the high-level political forum on sustainable development. It seeks to demonstrate how international partnerships can be leveraged through technical cooperation and innovative financing. Our presentation features a presentation that explains the technical aspects of catastrophe bonds and a discussion of an expert panel will help you to better understand the technical elements of that bond. Ladies and gentlemen, our experts come from the World Bank, the United Nations Office for Disaster Risk Reduction, the Economic Commission of Latin America and the Caribbean, and the Ministry of Finance and the Public Service. So again, we welcome you to our side event, and we hope that you will find it useful. I'll now move into the first section, the formalities, and I'm going to invite the speakers to speak for about 3 minutes in extending remarks to you. I'm going to invite Senator the Honorable Kamina Johnson-Smith to bring you remarks. Minister, the floor is yours.
We must understand why it is so important that disaster risk reduction features so heavily across the SDGs. And more importantly, why, as we seek to recover and build back better, we must examine and implement long-term strategies and systemic fixes to prepare for and respond to disasters, which are our lived experience. For states who already operate in an extremely tight fiscal space, the fact is that compounded costs of severe weather events and non-discretionary domestic priorities are crippling. Over the last decade, the Caribbean has seen only 1 year with less than 10 named storms. In 2020, we experienced a historic high of 30 named storms, and in 2021, the third highest with 21. An above normal season is forecast for 2022. So the need for catastrophe financing solutions within the region is not only obvious, but urgent. It is within this context that the government of Jamaica and international partners have successfully collaborated. The Catastrophe Bond, developed through the multilateral system, included technical assistance and support from the World Bank's International Bank for Reconstruction and Development. Official development assistance was also provided by the governments of the United Kingdom and Germany through the Global Risk Financing Facility and the USAID, which financed the premium and transaction costs of the bond. Jamaica has long embraced SDG 17, and we have a history of doing so in the realm of development finance. As we review progress on the SDGs and strategies to strengthen means of implementation this week, we acknowledge the support of our development partners. Jamaica's experience to be shared today is a model for how innovative financing instruments can be used to support small island developing states without increasing our debt burden. We believe looking more closely at the Catastrophe Bond is timely and relevant to small islands, developing states, and developing partners as we seek to finance recovery, mitigate disaster risk, and strengthen the resilience of the built and natural environment, and of course, to lessen the economic impact and prevent loss of life. This bond partnership is an example of how the established principles governing the Sendai framework and the Addis Ababa Action Agenda can be applied in recovery. We therefore encourage further partnership among states and development institutions to enable countries to build back better. I hope this afternoon's session invites discussion and creates opportunity for the first steps towards deepening relations and developing more creative solutions. I thank you.
Thank you very much, Minister Johnson-Smith. I now invite Dr. Wayne Henry, Director General of the Planning Institute of Jamaica, to add his remarks.
Thank you very much. Ms. Claire Bernard, Deputy Director General, Sustainable Development and Social Planning at the PIOJ, and moderator today. Senator the Honorable Camilla Johnson-Smith, Minister of Foreign Affairs and Foreign Trade of Jamaica. Mark Gordon, Senior Coordinator, Midterm Review of the Sendai Framework. Dr. Gary Conneal, United Nations Resident Coordinator in Jamaica. Mr. Trevor Anderson, Principal Director of the Fiscal Policy Management Branch of the Economic Management Division in the Ministry of Finance and the Public Service in Jamaica. Mr. Jose Angel Villalobos, Senior Financial Sector Specialist of the World Bank. Special invited guests, colleagues, good afternoon. So welcome to Jamaica's side event on financing for development. Small island developing states such as Jamaica face increased vulnerabilities to shocks, climate, health, economic, which when experienced severely curtail government's fiscal flexibility. This is evident by the health and economic consequences of the COVID-19 pandemic, which have been significant and are still being transmitted. In this current climate, governments have been tasked with the responsibility of increasing COVID-related expenditures, including on health, social, and economic support programs, while revenues remain muted due to sluggish economic activity, all while being cognizant of the ever-present threat of climate-related events, which, if they materialize, have the potential to erode hard-won macroeconomic gains. Rather than waiting on the occurrence of a climate-related shock to materialize to devise a response, the government of Jamaica has proactively partnered with key stakeholders to develop an innovative financing instrument in the form of the Catastrophe Bond to facilitate a quick and comprehensive response to specific climate-related shocks to safeguard and maintain the fiscal health and resilience of the economy. Today's side event will showcase catastrophe bonds as a key disaster risk financing instrument and the important role of strong multilateral and bilateral partnerships in developing the same. We are pleased with the strong support the event has received today and look forward to the rich discussion that will ensue. Thank you.
Thank you very much, Dr. Henry. We are now going to view a video message from Dr. Gary Conneal, the United Nations Resident Coordinator to Jamaica.
Your Excellencies, colleagues, ladies and gentlemen, good day. First, let me thank you, the government of Jamaica, and your Planning Institute for this invitation to share in this side meeting event of this year's high-level political forum. I'm happy to deliver introductory remarks as today you discuss catastrophe bonds within the arsenal of tools for supporting developing countries, especially during times of disaster. Wherever you were in the world, I believe that all friends of Jamaica may recall that on the 10th of September 2004, Hurricane Ivan devastated Jamaica with Category 4 winds and rain, causing more than $350 million in damages and claiming 14 souls. Similar catastrophic natural events, notably in 2017 for Dominica, have caused a huge amount of damage and lost lives and burden governments with debt that will take several years to resolve, delaying development, reducing prosperity, and stunting resilience. With the frequency and severity of natural hazards expected to increase with climate change, it is extremely important for countries, especially small island developing states in the Caribbean, to be as financially prepared when one occurs. And since the first catastrophe bond and insurance-linked securities was issued in December 1996, the market for disaster risk insurance has developed rapidly. The implementation and maintenance of a strategy to counter the fiscal risk of natural disaster are as important to Jamaica's economic security as the preservation of foreign exchange reserve adequacy and debt sustainability. We know now that SIDS in the Caribbean face a unique set of multidimensional vulnerabilities, which heavily constrain their ability to develop and build resilience against future shocks. One has only to look back to the recent past to see what devastation Hurricane Irma and Maria had on Dominica and Dorian on the Bahamas. Now, conventional income-based measures heavily understate Caribbean SIDS development needs and constrain access to finance, particularly concessional finance, of many upper and middle and high income yet highly vulnerable SIDS in the Caribbean. Which is why we at the UN, particularly my regional colleagues, continue to place much valued work in developing a multidimensional vulnerability index to complement existing income-based measures, while at the same time seeing the expansion and depth of risk financing for a range of natural hazards most relevant to SIDS. The case for resilience spending has never been more difficult to make than now, unfortunately. Now at a moment where countries emerge from the COVID-19 pandemic, debt-laden and fiscally squeezed, and facing the continued risk of natural hazards as countries across the Caribbean enter another above-average hurricane season. So preemptive action is very much needed for SIDS. While prearranged financing cannot stop damage caused by natural hazards, and particularly hurricanes, it can help countries mobilize support quickly to help those most vulnerable and rebuild critical infrastructure. Emergency funds and prearranged loans are often the cheapest way to finance disaster relief and recovery, but for SIDS, this is just not an option. It's not feasible for countries to set aside substantial funds, especially after financing the very severe pandemic that we've lived over the past 2 years. I commend the government of Jamaica and Finance Minister Dr. Nigel Clark for ensuring and institutionalizing Jamaica's multi-layered strategy for the management of fiscal risk of natural disaster. And these layers, budgetary provisions, the contingency fund capitalization, the credit contingent claim, the catastrophe risk insurance facility, and later the catastrophe bond in July 2021, which in Dr. Clark's words, addressed different layers of natural disaster risk from high frequency, low impact to low frequency, high impact events. Jamaica is the first small island developing country in the world to independently sponsor a cat bond with financial protection of up to $185 million against losses from named storms for 3 Atlantic hurricane seasons up to 2023. Following the success of Jamaica's cat bond in 2021, there is widespread interest in expanding this upon renewal in January 2024 to other countries across the Caribbean. At such a point, and informed by the new MVI, it is hoped that a new innovative financing instrument to surpass the current catastrophe bond will pave the way to new successes of disaster risk financing to support the Caribbean and SIDS more generally. I look forward and am fully committed to supporting these dialogues and actions that advance and perfect our approach to development financing for Jamaica, but for SIDS more generally. Thank you so much for including us in this event.
Our appreciation to Dr. Camille from the United Nations Resident Coordination Unit in Jamaica. I want to use this opportunity to say thanks to Senator the Honorable Camille Johnson-Smith, Dr. Wayne Henry, and indeed Dr. Gary Camille for laying the basis for the discussion that we're going to embark upon shortly. So thank you all very much. Ladies and gentlemen, we now turn our attention to the main presentation. Today's presenter is Mr. Trevor Anderson. Mr. Anderson is Principal Director of the Fiscal Policy Planning Branch of the Economic Management Division in the Ministry of Finance and the Public Service, Jamaica. He has held the position of Principal Director since 2016. An economist by training, Mr. Anderson leads the branch and coordinates the production of the fiscal policy paper and revenue estimates annually. Among the things he has led is the preparation of legislation for the Fiscal Commission and the draft disaster risk financing policy. He's therefore eminently qualified to share on Jamaica's approach to disaster risk financing, and particularly on the catastrophe bonds. Mr. Anderson, the mic is yours.
Good morning, Minister Johnson-Smith, Dr. Henry. I can't remember the names of all the other individuals, but all protocols observed. I think the presentation is being prepared for, is it full slideshow?
Can we put it on slideshow, please? Yeah.
As you can see, the title of the presentation is Financing for Development, Catastrophe Bonds. And the reason for this title is that catastrophe bonds play a role in ensuring that when disasters occur, particularly natural disasters, the budgets of small island states can respond effectively, timely, and efficiently in addressing the emergent socioeconomic challenges and needs of the population. So that's the reason for the title. And as you can see, moving from disasters and building back better. Can we move to the next slide, which would provide an outline of the presentation? So in terms of the presentation outline, while we wait for that to be loaded, I will be looking at the global challenge, the recent experience of Jamaica as it relates to disasters, and what has been Jamaica's response in terms of its strategy to deal with disasters, including the risk layering strategy. So here we go. Let's move to the next slide, please. So first we look at the challenge, as I said, the global impact of natural disasters. And then we will look at the natural disasters as it relates to the Jamaican experience. Then we will look at the response of Jamaica to this, this issue. And of course, look at the general outline of Jamaica's catastrophic bond. Then we look at an opportunity for the use of cat bonds by small island developing states to act as a buffer against the risk from this challenge. And then we will look at the role of international partners, and we will close off with a conclusion. So let's look at the challenge. So, global impact of natural disasters. According to the 2020 Ecological Threat Register, globally there has been a tenfold increase in the number of natural disasters since the 1960s. Annually, natural disasters cause hundreds of billions of dollars in losses, and the cost is rising. As climate change creates a more volatile weather system, in which hurricanes and other climate-related disasters are becoming more frequent and intense. Urbanization is also contributing to the increase in losses, as the concentration of people and assets, particularly in unplanned developments, increases exposure to natural disasters. Average total losses from natural disasters are increasing faster than insured losses globally, resulting in a growing protection gap. The increasing frequency of natural disasters and the losses associated with them are graphically highlighted in the next slide. And as we can see, beginning somewhere between 1975 and 1980, after that period, there is an exponential increase in the incidence of natural disasters around the world. And the future is not looking brighter. So this is an issue that all states, particularly small island developing states who are risk-prone, need to bear this in mind. Next slide, please. Let's look at the Jamaican experience. Now, like most Caribbean territories, Jamaica is highly exposed to natural hazards, such as earthquakes and hurricanes. As a result of its location in the Atlantic hurricane belt, the country is frequently under threat from hurricanes or tropical cyclones. Over the last 3 decades, Jamaica has been affected by more than 30 cyclones, tropical cyclones, including Hurricane Ivan in 2004, which accounted for losses of some US $580 million, equivalent to approximately 8% of GDP. The losses caused by Hurricane Gilbert, which struck Jamaica in 1988, were far greater. It is estimated that this destructive hurricane accounted for losses equivalent to 65% of GDP. It essentially flattened Jamaica, moving right through the middle of the island. The World Bank in 2018 estimated that Jamaica faces probable maximum loss from hurricanes of US $3.5 billion, or some 23.5% of GDP, while the annual average loss from hurricanes is assessed to be US $67.3 million, or approximately 0.4% of GDP. Despite improvements in protection from natural disasters, total coverage of approximately US $555.8 million in the first quarter of 21-22 from the portfolio of financial instruments, inclusive of the IDB Contingent Credit Facility, the CRIF, Contingencies Fund, the Natural Disaster Fund, still remained inadequate resulting in a significant financing gap. Now, can catastrophe bonds help countries faced with natural disaster risks? And the answer is yes. Catastrophe bonds are risk-linked securities which transfer a specific set of risks, typically catastrophe and natural disaster risks, from an issuer or sponsor to capital market investors. In so doing, the investors take on the risks of a catastrophe loss or named peril event occurring in exchange for an attractive market rate of return. Should a qualifying catastrophe or named peril event occur, the investors would lose some or all of the principal they invested, and the issuer will receive a payout to cover their losses, with disbursements generally executed in a pretty short time. Now, cat bonds are typically used to protect against low frequency, high severity events in light of the unusual large coverage that they provide. They generally complement other risk financing instruments in a portfolio that targets a risk layering approach. Cat bonds are attractive to investors because the unique investment opportunity that they present, which is uncorrelated to financial markets. Therefore, they constitute a useful asset class for diversifying risk in an investor's portfolio. What has been our response? Recognizing the need for a disaster management response locally in light of the significant macroeconomic, fiscal, and development risks that natural hazards present, the government of Jamaica, with support from the World Bank, embarked on a comprehensive strategy aimed at enhancing resilience to natural disasters and climate shocks. A critical component of the strategy is the development of a national natural disaster risk financing policy expected to be tabled in Parliament during this fiscal year, the primary objective of which is to enhance Jamaica's fiscal resilience to natural disasters. This policy promotes a multi-layered approach to disaster risk financing that combines risk retention and risk transfer instruments. Consistent with the policy, the government of Jamaica is adopting a risk layering approach to financing natural disaster risks. This involves establishing adequate funds and reserves to retain those costs associated with high frequency, low severity events such as floods or heavy rainfall, and transferring risks related to low frequency, high severity events such as major hurricanes and earthquakes through the purchase of insurance instruments. Now, the multi-layer risk approach to financing disaster risk, as you can see on this chart, the disaster risk runs from low risk at the bottom and gradually moves up to high risk. So what we have is the probability of the event, of course, is operating in the opposite direction compared to the severity of the impact. So a low risk event tends to have a probability of occurrence being pretty high, such as heavy rainfall, flooding, but severe catastrophic events tend to be low risk and high impact. And so that is what is being explained. And then to the right, we have the distribution of the menu of instruments being applied. starting with risk retention instruments, contingent budgets, reserves, annual budget allocations. Then we have contingent lines of credit. And finally, at the top, to deal with the heavy catastrophic risk, we have disaster risk finance insurance, inclusive of the CAT bond. So that's the multi-layer risk approach to financing disaster risk. Next slide, the CAT bond. The GOJ, supported by the World Bank and other international partners, celebrated the historic launch of the CAT bond in July 21, becoming the first country, indeed, the first of any small islands state to independently sponsor the CAT bond. The instrument provides financial protection of US $185 million against losses from named storms for 3 Atlantic tropical cyclone seasons ending in December of 2023. The issuance of the catastrophic bond is consistent with the government's multi-layered approach to disaster risk financing aimed at mitigating adverse fiscal impacts of tropical cyclones and consequently bolstering Jamaica's economic resilience. The payout triggering mechanism involves a cat-in-the-grid structure covering Jamaica landmass as well as coastal areas surrounding the mainland. Payouts are triggered when a named storm event passes one or more of the grids and the central pressure of the storm is at or below the specified intensity thresholds. The size of the payout is related to how many grids are breached, and this granular approach allows us to optimize and, for example, provide higher thresholds for geographical areas where losses are likely to be higher from a direct hit. Example, Kingston and Montego Bay. The World Bank Treasury acts as an intermediary between Jamaica and our catastrophe bond investors. They collect the premiums from Jamaica and remit these funds to the investors in the form of bond coupons. They also hold custody of the principal invested by the investors and will pay this out to Jamaica if a natural disaster event breaches the established thresholds. The government of Jamaica has indicated that Jamaica's multi-layered strategy for the management of fiscal risk of natural disasters will be institutionalized so that it becomes a permanent strategic priority for Jamaica. The use of catastrophe bonds by small developing states. Now, climate change has exacerbated the disaster risk reduction and development challenge, particularly for small developing states, as the frequency and intensity of extreme weather events has grown, making it harder to limit exposure and reduce vulnerability. Although rising financial losses from disasters continue to impact small developing states disproportionately, they remain constrained in their ability to implement ex-ante disaster risk financing. Provided the requisite support secures affordability through pooled or independent initiatives, small developing states can utilize catastrophe bonds for disaster reduction and development. Jamaica's successful launch provides evidence of existing opportunities for developing nations to utilize these risk-linked securities. Next slide. The use of the catastrophe bonds by small developing states. These CAT bonds may be used to enhance 3 of the requirements for sustainable growth. Bolster financial resilience, which in turn strengthens your response to socioeconomic resilience and enables you to also strengthen your physical resilience through building back better. Next slide. Physical resilience may be enhanced through the Build Back Better approach, as I said, when catastrophe bonds financial resources are accessed. Over time, the disaster risk reduction is also achieved. Enhancing socioeconomic resilience may be facilitated through fast access to resources to respond quickly following the impact of a payout-triggered event, thereby reducing immediate poverty that results from the instant loss of livelihoods, as well as transferred poverty, which evolves from children suffering due to the impact of adverse events on their families. Financial resilience may be enhanced through the adoption of fiscal rules, which over time enables resource-challenged small states to gradually reduce their debt burdens, freeing up sorely needed fiscal space to address the socioeconomic needs of their citizens. This freed up fiscal space can allow each small island state to put aside emergency resources to help shield the budget from the impact of the natural disasters. Looking ahead as our next step, we'll see the World Bank examining the possibility for the development of regional cat bonds for the Caribbean. Next slide. Role of international partners, very important. Developing resilience is a multi-dimensional challenge. While resources are important, it is also about policies, governance, institutions, and capacity. International partners play a critical role in this regard. For example, the World Bank provides analytical advisory services and convening services, provide technical assistance to enhance capacity, galvanize climate resilience support through donors, and the donors provide the financial contribution, encourage broad-based support. And of course, we have the modeling and analytic agencies providing their services, of course, for a fee in determining the design of these cat bonds. In conclusion, climate change and rapid urbanization has precipitated numerous disaster-related challenges that continue to undermine efforts to achieve sustainable development locally and globally. International agreements, chiefly the Sendai Framework and the Paris Agreement, meticulously documented these challenges and together promulgated a broad framework of strategic responses. Jamaica embarked on its comprehensive disaster risk management strategy, covering financial, physical, and social resilience. The natural disaster risk financing policy is a critical component. The policy promotes multi-layered strategy to disaster risk financing and is aimed at building fiscal resilience to natural disasters, which is an imperative to safeguard the hard-earned gains achieved over recent years and entrench the country on a path to sustainable development. The CAT bond, successfully launched by Jamaica, supported by international partners, complements the suite of disaster risk financing instruments and narrows the country's disaster risk financing gap. The historic launch established a precedent and unveiled the existence of opportunities for developing nations with the requisite support to utilize catastrophe bonds to improve protection against natural disasters, reduce disaster risk, and ultimately advance their development. I thank you for your attention.
Thank you very much, Mr. Anderson. You have really laid out for us very clearly what are some of the issues that a cat bond can assist a country in addressing. You talked about the kinds of resilience that, the types of resilience that we can focus the cat bond towards. And you showed us definitely how it can help us, embarking on that route can help us to reduce what I think Dr. Henry spoke about earlier as the fiscal inflexibility arising from our situation. We're going to explore some of these issues a little bit more as we move into the panel discussion. And so I'm going to invite the panelists for the next session to get ready. The panelists are yourself, Mr. Anderson, Mr. Villalobos, sorry, sir. Mr. Oh, I'm getting confused this moment. Mr. Mark Gordon and Mr. Sheldon McLean. So I'm asking the panelists to stand by, and we're going to be exploring a little bit more about how cat bonds can assist we have some specific questions that I'm going to pose to help us to focus the discussion. So I'm going to start with you, Mr. Anderson, to tell us, and I think you did a little bit of that already, but if you could tell us a little bit more why you thought it was important for Jamaica to seek to issue the CAT bond, and also to see whether you believe that that road that we're embarking on will lead to an increase in the national debt. So we start there, and then I'll come back with a few other questions for you.
Okay, thank you. Thank you, Claire. It was extremely important for Jamaica to embark on the issuance of this historic CAT bond, mainly because, one, it completed the risk layering approach in terms of the suite of instruments as outlined in the disaster risk financing policy. It also helped to close the issuance of that 185 million catastrophe bond, helped to close the estimated financing gap that would emerge if Jamaica were to be hit by a catastrophic event. We are by no means out of the woods, but we have begun the journey. And it is critical that as we move towards debt sustainability, we also move towards fiscal and financial resilience, enabling the government of the day to efficiently and effectively respond to a crisis. And let me turn to the secondary question as it relates to the debt. The CAT bond has no impact on the country's national debt, unlike a CAT DDO. So it's like an insurance policy that you purchase, and following the period of insurance, if there is no event to trigger the policy, then your premiums, of course, remain with the investors. However, if there is an event which triggers the bond, the payout, depending on how many of the grids were triggered, that will determine the level of payout, but absolutely no impact on the debt.
So what happens then when the bond matures and if there is no event, triggering a payout, what happens in that case? Okay.
So just like a regular insurance policy, motor insurance or house insurance, when the policy expires, it means that you need to purchase another policy to ensure that you continue to be protected. So it would be wise over the period of the insurance period that you put aside resources to go towards the possible re-engagement of investors again for another CAT bond.
Okay. All right, thank you very much. I think I'm going to invite Mr. Jose Angel Villalobos to talk to us a little bit now. And just to introduce Mr. Villalobos, he's a trained actuary, risk manager, reinsurance underwriter, and he has had over 40 years experience in the risk financing field. And the last 11 of which have been spent working with the World Bank, working mostly in disaster risk financing initiatives. And really, he's been serving over 30 countries. So we want to hear from you, sir. Want to find out what you think were not just the best reasons for introducing the bond, but wanting you to tell us how the bond was financed, how the payouts work, perhaps how long will a bond last for, and from your perspective, what are the risks and benefits of actually floating such a bond?
No, first, thank you for the kind invitation to participate in this event. I would try to be straight to the questions. First of all, the CAN bonds actually have they have two phases. One is of technical assistance that included the CAD modeling, the generation of CAD bonds prototypes, but even more important is the purpose of building capacity, in particular inside of the Ministry of Finance. So the knowledge live with the country, and the country is not as dependent, technically speaking, from the World Bank. So that is the first phase. In particular, this first phase was financed by the UK government, and including not only Jamaica, but also Grenada, Dominica, and St. Lucia. Okay, so that is still ongoing work. The second phase, that is the actual placing into the ILS insurance-linked securities market of the CAD bonds, involves several partners. I mean, one is the Global Facility for Disaster Reduction and Recovery. They provide a grant for more than $16 million. The USAID, they pay for $5 million. And this total amount is for paying for the coverage for the 3 years, and also the structuring fees, but also the government of Jamaica, they pay the World Bank Treasury fees for the placing of the bond. So there was many partners on this initiative.
Okay.
How the payouts works is very simple. I mean, this is a insurance say from the point of view of the country. So everything is defined as explicitly detailed in the contract. So there is the definition of the calculating agents. It is the company that defines if a trigger has happened, and if happens, how much is going to be paid. So the information is passed to the treasury of the World Bank and to the investors, and simply the treasury is going to send the money to the Minister of Finance, and the investors lost the money. That's it. And of course, this is not debt. So once the government receives the payout, say the 50 million or 185 millions, whatever, this money don't need to be repaid back to the investor. That is a key difference. It's like insurance. If you receive a payout from the automobile, you are not expected to pay back to the insurance company. That you pay the premiums in advance. So that is very way. So we try to make the payouts the quicker as possible. So if I don't recall wrongly, I think that is about 1 month in the case of the tropical cyclone for Jamaica. So every time we try to shorter the periods of payment. The coverage is going to end on December 21st, 2023. And as Trevor mentioned, we are right now working on the potential Caribbean regional CAD bond, based on the very successful experience of Jamaica, and also building on the experience of the 4 countries of the Pacific Alliance, meaning Chile, Colombia, Mexico, and Peru. So far, there are 8 countries interested on looking and exploring the possibility. Nothing of this is set on stone, and even the markets at the moment of the issue need to be evaluated and see if there is value for money. Right now, there is a mission in St. Lucia, and next weeks, and there is another for Dominica in order to conduct the public asset survey, the one that we made for Jamaica, of course, in order previously to the issuance of the CAD bonds. And this public asset survey has been already finalized for Grenada. So the aim is for by when the Jamaica cat bond expires December 21st, 2023. If there is if the value for money is there, to move forward with a regional cat bond. The benefits of the cat bond, they are some. First of all, it's very important to stress the fact that the cat bond is not the solution of all the natural disaster financing. No, it's just part of the solution. That's it. So that is why it's so important to keep in mind, as Trevor mentioned, the risk ledgering approach that is founded on two probabilistic laws that works not only natural disaster for many other events. So this is having this in clarity is maybe one of the key benefits of the cat bonds to complement the existing or as the foundation for start creating this financing strategy. And of course, one considering this framework, the point is that this instrument is a way to transfer the disaster risk from the government. So reducing the contingent liabilities and removing some of the volatility arising from natural disasters, both in the fiscal space and the macroeconomic space. And mentioned before, the cat bonds are designed in order to provide a quick payout. So they are designed in order to reduce the gap of the emergency and rehabilitation post-disaster phases. Of course, money is money, it's fungible. So the money can be used at discretion of the government for reconstruction purposes. Because now Jamaica they have several instruments, several tools in the toolkit in order to deal with the disaster. Cat bonds, by definition, they don't have counterparty risk. They are transactions that are fully funded. In this case, the World Bank is getting the money from the investors because the World Bank is issuing a bond. That is why the name, and this money is kept on the trust of the World Bank. If the payout is triggered, the World Bank simply send the money to the country. If no trigger or there is some money left in that pocket, of course the money goes back to the investor. That's it. But there is not a risk for the country. Say that like if in traditional insurance, the company is broken and then there is no money for pay for the claim. So no counterparty risk. As mentioned by Trevor, another very important characteristic is that don't increase debt. The name is not the best for saying in some way, but it's not debt. So in no way it's going to increase the debt. And it's a complement to all the other instruments. And then in the construction of the different prototypes, we take into consideration all the different instruments, the CRIF insurance policies, the contingency loan from the Inter-American Development Bank, the emergency fund, $31 million, and so on and so forth, in order to make sense, financial sense for the government of Jamaica. This is not cheap. Nothing is cheap. Nothing is free. So the idea is to really optimize as much as possible the usage of the funds. The cat bonds also help to neutralize the basis risk of other parametric instruments. In the case of Jamaica, that is there is the CRIF insurance policies. They are parametric, and then by definition they have basis risk. Basic risk means that the model can be wrong, and then they are actual losses in the grounds, and the model says here nothing happens and there is no payout. Okay, and something similar might happen with the contingent loan of the Inter-American Development Bank because they have other type of trigger that is affected people, and in the case of the CRIF, the trigger is model loss. So these the cat bonds are made on the cat intergrid. So the idea is to neutralize. Say if one product is not working because of the basic risk, the other one might provide some resources. Okay, so that is the importance of having this concept of portfolio and the risk layering approach. Nothing is perfect, of course. So cat bonds, of course, is not a not exception, and definitely the major risk comes from the basic risk. That's it. I mean, the model can be wrong. Absolutely, they use a model for even it's the state of the art right now, but it's still a model. So we put a lot of effort in order to have a sound technical design, and every time that is a renewal, we recommend strongly to review and try to improve a little bit more. For example, usually all the tropical cyclones, cat bonds, and parametric insurance, they work on the maximum winds in the particular cell. In this case, for Jamaica, we move a little bit back, step back forward and produce the cat bond based on the accumulative event of the winds across the different grids. So that is a way to try to reduce the basic risk, not minimize, because we don't know what is the real data. That's the problem. But we are sure we are reducing the basic risk. So the technical design is very important. Is an evolving stuff. Also, this is a new kind of new and complex instruments, maybe like the derivatives and futures some decades ago. So communication with the public is very important. Here we are talking about governments, it's not just a reinsurance company using innovative financing instruments. It's about the public sector. So it's very important to communicate a lot with the public and keep the expectations in the right place. For example, this the trigger based on the physical characteristics of the hazard, in this case the wind of the low pressure, is easier to explain to the public. It's simple, not happens that having other types of trigger. So that is also part of the step of the analysis and of the risks. I mean of having this. And also, the market is continually evolving. Sometimes the market, there is a lot of supply. Sometimes the supply is limited, and then the prices go up. So it's very important every time that you're trying to issue a new cat bond or renew a cat bond, to actually evaluate the condition of the markets and see if it makes sense or not. Maybe another instrument can be, or another market may be reached. And the final risk maybe is how to finance the renewals. I mean, in Jamaica, in these fields, in this very successful emission, there was a lot of support. Hopefully this is going to continue, but this is going to end at some point. So it's very important to create, and we are here also to support the governments to create an exit strategy and make this viable in the long run. I not particularly worried about that, because Jamaica and other Caribbean countries, they have demonstrated in time the discipline, say with the CRIF, with the insurance policy in the CRIF. At the very beginning, there was some donors involvement, but after that, most of the countries pay for their own premium. Even now, with the impact of the still ongoing pandemic, so that's a demonstration of the fiscal discipline and the relevance mentioned at the very beginning. But still, it is important to have an exit strategy and be prepared for this potential, not just the coming one, but for the rest of the time. In
Thank you very
particular,
much, Jose.
Okay.
We're going to stop now and come back to you
Okay,
in a
thank you.
bit. So let me invite Mark to speak now. Mr. Mark Gordon is the Senior Coordinator for Midterm Review of the Sendai Framework, and he works with the United Nations Office for Disaster Risk Reduction. I know colleagues were asking you to put your questions in the chat, and after all the presenters have spoken, we will come back to address your questions. Mark, the floor is yours.
Thank you very much indeed, Chair. Minister Johnson-Smith, Excellencies, esteemed ladies and gentlemen, the United Nations Office for Disaster Risk Reduction is delighted to be able to contribute to this fundamentally crucial conversation convened by the government of Jamaica. A conversation that comes at a critical inflection point in our efforts to pursue sustainable and regenerative development within planetary boundaries, and thus the health and well-being of all peoples and the ecosystems upon which we depend. In responding to some of the questions you have put, Chair, I will present a broader perspective on risk reduction and the role of risk transfer mechanisms, including cat bonds, in crafting more resilient societies. I will bring 4 elements that I hope will stimulate a vibrant and explorative discussion, examining some of the elements with which we must contend if we are to redress our relationship with risk, to shift from managing disasters to managing risk before it manifests as a shock. So let me begin with the first point, and this has been touched upon by previous speakers. Risks are evidently growing, and our failure to prevent the creation of new risks and reduce existing risks mean that corollary shocks are growing, incurring greater losses and damages with wider macroeconomic implications. Essentially, the cost of disasters is rising, and current approaches to financing risk prevention, risk mitigation, and disaster recovery are just simply inadequate. Economic losses due to disasters are rising to levels never seen before. In 2020, total insured losses from natural and man-made hazards were up by 25% compared to 2019. And this does not include the impacts of the COVID-19 pandemic, nor the mountain of uninsured and unreported economic losses, which dwarfs that which is insured. As such, impacts cascade through financial systems. They present a systemic financial risk. With the interconnection of global financial and economic systems, previously isolated events are developing into large-scale catastrophes with implications that are hard to anticipate and manage. As the COVID-19 pandemic and the climate crisis have shown us, the economic impact of disasters can prompt capital flight from exposed and vulnerable countries and sectors of the economy, and further trigger debt distress. The fiscal impacts of the risks endogenous to social, political, ecological, and economic systems, and the decisions, actions, and inactions contained therein, severely limit the ability of many countries, especially developing countries and particularly smaller economies such as LDCs and SIDS, to invest in sustainable development. There is a chronic underinvestment in disaster risk reduction for resilience in nearly every country. Second point speaks particularly to cat bonds, which clearly have an important role to play post-disaster, but they can be strengthened to promote pre-disaster investments in risk reduction and prevention. Evidently, risk transfer mechanisms are part of a suite of options available to countries and non-state actors to deal with the consequences of risks that manifest as shocks, offering some degree of financial protection. However, such mechanisms are inaccessible to many. The insurance coverage rate in most developing economies is well below 10%, and in some, almost zero. This makes any recovery from disasters difficult, especially for the poor and the most vulnerable. The role of risk-informed financial systems, including insurance, in strengthening disaster risk governance is one of the issues that we highlighted in the 2022 UN Global Assessment Report on Disaster Risk Reduction. Disaster risk transfer and insurance have received considerable attention in recent years. Cat bonds are a central component of disaster risk transfer, and they have a critical role to play in leveraging access to quick finance to buffer the financial impact of disasters. They, of course, provide governments with much needed liquidity in the event of a disaster. And cat bonds are particularly valuable in this respect. But they also allow a transfer of risk to an insurer or reinsurer. The risk, as well as the reward, can be transferred directly to capital market investors. And of course, Jamaica has been a leader in the development of the application of national cat bonds, as well as national disaster insurance mechanisms. And as we have heard from previous speakers, the funds are fungible. And so risk transfer mechanisms, such as cat bonds, can be strengthened to better support investments in risk reduction and resilience. For example, cat bonds could assist in approaches that prevent and/or mitigate disaster risk before it manifests as a shock. They should be designed to provide incentives and much needed resources to support countries to build forward better post-disaster in a way that addresses prevailing systems vulnerabilities and thus reduce risks, building resilience to future shocks and hazards. That said, our primary goal should be prevention. And the way to prevent a disaster is to reduce the risks that contribute to it. Risks that are built by human agency, by the decisions, the actions and inactions that are taken in socio-ecological and technological systems. By accurately pricing risk, we can incentivize risk reduction. In respect of risk transfer, if companies and individuals see how much risk is costing them in increased premiums, they are more likely to take action to reduce that risk. UNDRR is working with the insurance sector to integrate disaster risk reduction. Through its participation and as a founding member of the Insurance Development Forum, the United Nations system is promoting better risk assessments and modeling in the insurance sector. And in November 2019, the UNDRR established a partnership with the International Cooperative and Mutual Insurance Federation, ICMIF, to explore the use of insurance-based instruments to incentivize risk-reducing behaviors. We can, of course, learn from examples where risk-based premiums have helped incentivize prevention. France is just one such example, where a disaster insurance system called the Catastrophe Naturelle incentivizes the implementation of risk prevention plans to reduce risk as part of local flood risk management. Premiums have also played a considerable role as a tax to fund under-resourced sectors, such as local law enforcement and motor vehicle safety. Equally in healthcare, where such approaches can be used to promote healthy lifestyles to reduce long-term costs, for example, from non-communicable diseases. The third element is around, while the fact that risk transfer mechanisms and cat bonds are important, as we've heard from previous speakers, they must be part of a layered approach to disaster risk reduction financing. The current approach to funding disaster risk reduction is lagging well behind the rapid rate of creation and increasing complexity of risk. It is inadequate for the implementation of multi-hazard, prevention-oriented strategies and measures to reduce disaster risk, and remains heavily focused on reactive measures, such as contingency funds, insurance, and cat bonds to finance post-disaster response and recovery. However, risk transfer cannot be a substitute for instruments that finance the reduction of existing risk and the prevention of new risk. Cat bonds and other risk transfer mechanisms do not cover the full cost of disaster recovery and rehabilitation. They cannot keep up with the rising tide of economic and social losses due to disasters. Risk financing or transfer is but one layer in the comprehensive approach for financing prevention. Disaster risk reduction financing requires a multi-layered approach that blends ex ante and ex post financing. And a new and fully integrated approach to financing is therefore urgently needed. And so we commend Jamaica's leadership in the development of the menu of policy options for financing for development in the era of COVID-19 and beyond. This important document calls on countries to do more to finance the implementation of national disaster risk reduction strategies, risk-informed investment, and for development banks and the international financial institutions to align their work with the Sendai framework. Investing in disaster risk reduction for resilience is one of the three priorities of the Sendai framework, and is integrated into the Addis Ababa Action Agenda. Since 2019, the Economic and Social Council has been encouraging member states to deliver on these commitments by shifting the balance from investing in response and recovery to investing in prevention and risk reduction, including through the development of national disaster risk reduction, national financing strategies and instruments. Such strategies must pursue the optimal mix of financing from all available sources, including cat bonds, national and regional insurance schemes, but also sovereign debt restructuring and contingency funds, as well as forecast-based financing and innovative integrated financing for prevention and risk reduction. There is an urgent need for international financial institutions and multilateral development banks, as well as the broader financial sector, to focus on the development of disaster risk reduction financing instruments and approaches. Such instruments can include risk reduction and prevention bonds, blended financing tools and pooled funds, as well as guidance and methodologies to include disaster risk reduction in decisions of business and institutional investors. Central banks and credit rating agencies can also align their strategies and operations with the framework to ensure that they prioritize risk reduction. National disaster risk reduction financing strategies can enable countries to estimate the resources needed to implement disaster risk reduction strategies and enhance integrated national and local budgetary allocation for prevention and risk reduction in all sectors. More innovative approaches across public and private finance are also needed, such as conducting analysis of national financial stability in the event of a disaster, and the development of common standards, lexicon, and taxonomy to tag and track cross-sectoral expenditure and investments in disaster risk reduction and assess their resilience dividend. Monetary authorities can also promote investments in risk reduction and resilience through regulations attached to lending streams. Development partners, international financial institutions, and multilateral development banks are called upon to support this by aligning their strategies and operations with the Sendai framework and national disaster risk reduction strategies. And the final message concerns the bond market. And this is being strengthened with new products that support investments in resilience and risk reduction. But I think, as we all feel, the pace needs to pick up. The green bonds market has seen immense growth, with the market starting to take off in 2014 when $37 billion was issued. In fact, the market kicked off in 2007 with the issuance from multilateral institutions, the European Investment Bank and the World Bank. And then by 2018, issuance reached $167 billion, setting yet another record. Green bonds fund projects that have positive environmental and/or climate benefits. With increasing risks, including climate risks, it is expected that premiums will increase significantly, just as governments will have to raise taxes. In fact, agricultural disaster insurance premiums have already increased by an average of 25%, and in some specific areas by more than 50%. Each of these instruments has its strengths and challenges. For that part, cat bonds and green bonds solely cannot prevent the impact of disasters stemming from various hazards, whether natural or human-induced. Could a prevention or resilience bond help broaden the scope by addressing multi-hazard systemic risk, avoiding the creation of new risks and generating much-needed liquidity? While a prevention or resilience bond and a catastrophe bond use the same financing model, the difference lies in the two scenario modeling: business as usual and protective infrastructure projects. Prevention resilience bonds estimate the difference in the expected losses when a catastrophe occurs with and without the project. That difference is captured as a resilience rebate, and this rebate can be used to fund the project itself. Such a bond instrument could combine the strengths of cat bonds, climate resilience bonds, and green bonds amongst leveraging finance for prevention, adaptation, and mitigation actions, accelerating implementation of the SDGs, incentivizing risk and efficiency-based infrastructure design, diversifying the base of issuers and investors, building confidence in the market, strengthening financial health of the issuer, providing coverage, access to rapid liquidity and rebate in the case of catastrophic events, integrating multi-hazard risk into investment decisions, perhaps targeting developing countries, and leveraging international aid, reducing the burden on humanitarian financing. This could also help in modeling risk prevention and helping to better price the value of it, and thus, finally, to reduce investment risk to investors by applying a risk prevention lens. So, Chair and colleagues, I hope that that's proved stimulating, and I look forward very much to the discussion to come.
Thank you very much, Mr. Gordon. That certainly has been stimulating, and I'm sure that Mr. Anderson is perhaps looking back at his disaster risk financing strategy to see to what extent he has covered all the issues that you raised here. And I'm sure there are also partners who are possibly thinking, how can we work with some of these countries to develop these prevention and resilience bonds. But let me get to the questions, and we'll invite colleagues to place their questions in the chat. I see one here from Rob Wheeler. I don't know, Jose, whether you can see it. I think it's directed to you. It's asking, it says, given that developed countries have likely caused the increase in disaster risk severity and increases, wouldn't it make sense for the developed countries to finance the development of a global or regional fund so that any revenues gained from country payments can go back into the program or fund rather than go to investors? What are your views on that? It's quite a question. Yes, please, Jose.
Yeah, actually, this is a great idea. I mean, actually, the Caribbean, you have that model, that is the CRIF, the Caribbean Catastrophe Risk Insurance Facility. The issue here, I mean, about the CAT bonds is taking advantage of the capital offered by the investors in order to fund or transfer some of the disaster risk. So the issue here is how much capital can the countries set aside in order to take their own risk? So there is no risk transfer. There is a kind of contradiction. In the case of the CRIF, the company is a private company set with a particular capital, and that is why the CRIF offer X amount per hazard per country of coverage to the members countries. So this idea, I think that in theory is good. They already is in place in the Caribbean and Central America countries, same in the Pacific Islands and in Southeast Asia. But for this particular kind of instruments, I think that it will be a little difficult because of actually the countries are taking advantage of the capital offered by the investor for transferring the risk. So it's there is no, otherwise it's not risk transfer in place.
Okay, thank you very much. I'm not seeing any other questions. Is there another question?
Perhaps, Chair, if I may just very briefly
yes.
reiterate the point earlier that I was making of how additional capability and financial resource can be deployed to address well ex ante, well before the risk manifests as a shock in elements within all sectors and all scales, to be able to address the underlying drivers of risk creation and its propagation across economic, social, ecological, and political systems. So I enjoyed very much Mr. Wheeler's question. I think that, yes, that is something, as Jose Angel has highlighted, is a model that has been employed, including in the Africa risk capacity in Africa also, essentially to sustain that program. But if an element of that revenue that is generated can also be then allocated directly to preventative measures, to looking at how do we address the aspects of risk creation at source, for want of a better term, then we have a much better chance of actually minimizing the possibility that these manifest as the kind of shocks that ultimately require ex post mechanisms to soften the blow, whether in terms of financial protection or other socioeconomic measures to reduce suffering and loss.
Thank you very much. Mr. Anderson, I wonder whether you would want to take a shot at that, particularly given where you're coming from and the fiscal inflexibility. I think that Dr. Henry made reference to, what is our ability to invest more in these kinds of ex-ante systems and funds, rather than wait to be reactive responding in our response capabilities.
Thank you, Claire. Thank you. What I would say is, it all boils down to an individual state's capacity to seek out and acquire appropriate levels of protection. And I had made a point in the presentation that from a point of view of building fiscal or financial resilience, one could perhaps look at the whole matter of the adoption of fiscal rules. I think it's very important because it helps to put a country on a trajectory of financial responsibility once they begin to employ fiscal prudence, and that will enable them to acquire the necessary resources to invest more, to build their levels of protection much stronger than would otherwise have occurred. I think it's extremely important that countries look at that and treat it as a very important starting point.
Okay, thank you. There was reference, I think, Mr. Anderson, earlier to the possibility of a regional cat bond. Was it you who had mentioned that? Because I think there are persons who want to learn a little bit more about that. Our colleague from ECLAP, unfortunately, did not join, but I'm wondering if there's anyone, whether you or any of the other partners, panelists can shed some light on that.
Okay, I don't have the technical aspects of the regional bond to go into details. I would defer to Jose,
Okay.
but I would want to think that the whole matter of the regional bond is going to boil down to the different risk profiles across Caribbean territories, and to find a way to bring these risk profiles together in a coherent, systematic way, and to be able to affect or impact the issue of affordability. But with respect to the regional catastrophe bond, I would defer to Jose to provide some more details.
Okay, Jose, please.
Thank you. No, actually, there are ongoing activities on this. We are not in the business of selling cat bonds exactly. So we are more on the business of promoting public policy on the financing of natural disaster. So we are already finalized the surveys for the public assets for St. Lucia, or for Grenada, sorry. And right now there is a mission in St. Lucia and going to Dominica. And the purpose of that, and I mentioned before, we already do that for Jamaica. We are going to provide this exposure data set in order to help to improve a little bit a very important aspect that Mr. Gordon has raised, that is about the prevention. I mean, to improving the quality of the infrastructure. So that is part of the whole analysis. Here, we are talking more on the cat bond because that is the topic, but the purpose is broader. And then using not only the improved public asset information, the database that usually in all the countries around the globe, there is not in existence these databases enough quality for financial purposes. Okay, so the first step is to have this jointly with the public or the private sector assets. We are going to run the CAD modelings. We are going to create the risk profiles for each of the countries, and eventually generate the prototypes. And hopefully, as we expect that the risks are less than perfectly correlated, some advantages can be taken in terms of pricing for the joint for the countries. So right now we are working with 4 countries. Jamaica is done, even in terms of the CAD bonds, and we are working with the other 3 countries. And we expect to include 4 other countries that they want to explore the possibility. So that is the plan. And mentioned the idea is to be ready, technically speaking, by December 21st, 2023, and keep promoting. I mean, the most important, I fully agree with Mr. Gordon. I come from the insurance industry, but for sure, the improvement of the physical assets is the most relevant aspect. It's the actual thing that prevent the losing of lives and the destruction of the property, period. The financial instruments, risk transfer of financing follows that. Say that we cannot wait for having this perfection in the quality of the infrastructure in order to pursue the risk transfer and the financing of the hopefully conscious retained risk. That's a very practical point of view, but we are working in 2 dimensions. Any risk management textbook is going to set the steps, and after the identification of the risk is the mitigation of the risk. That's it. And then at the very end, one of the activities is looking for some financing instrument for disaster. Okay, so so that is they are the plans. With respect money, we are just starting looking for having the meetings with the countries. The aid as I'm interested in. We just started having some initial meetings with donors, looking for some potential of financing for the technical assistance for the additional 4 countries, and for hopefully also try to find some financing for the premiums and the structural fees. Okay, so that is a process, but that is we are very clear on the deadlines and the and the activities. Thank you.
Okay, thank you very much. One of the questions which has reappeared in the chat, I'm not sure whether that person was here earlier, is people want to know what kinds of activities can be financed with resources from the bonds. I think that's the question that was asked. Let me just find it again. Yes, it says, what types of activities can the bond monies be used for if there's a natural disaster? I believe you had said it, but just very quickly as we approach closure, if you could just repeat it for that person for me, Jose.
Yes, I already said. I mean, the money is fungible, so the payout is going from the World Bank to the Minister of Finance, and it's up to the government to decide how to deploy the money or save it, maybe it's a positive basic risk. So there is a payout and there is no actual damages. So they can save it, as happened in Peru and the Philippines. So so they are going to use whatever they want.
Okay,
There's no
thank you.
restriction.
Colleagues, we're going to invite you to follow up with your questions to submit them to the SDG unit at the Planning Institute of Jamaica, and we will contact our panelists so that we can get answers for you. We're fast running out of time, so it really is left for me to say thank you all for participating in this side event. We hope that the information shared with you was useful and will help in your understanding of cat bonds and how they can be part of the toolbox that your country and indeed ours use for addressing disaster risk. Earlier in the week, we heard the president of the Caribbean Development Bank identify 3 important frameworks that we need to pursue for long-term development. And the one of building resilience is a very important one. So we want to thank you all for being here, and we hope we've contributed to your plans to build resilience in your development planning and for your country. Thank you all very much, and see you soon.
Thank you all very much.
Okay.
A pleasure.